Hello, accounting scholars, and welcome to chapter 15. Hey, this is a short chapter. We've got a couple important concepts we need to review, so let's get started. Okay, there are a couple important things that you need to remember regarding stockholders' equity transaction and recording of those particular transactions. The first is to keep contributed capital. These are primarily capital stock transactions separate from your earnings transactions, and those primarily are related to retained earnings. So, as you might expect, you want to, in owner's equity, you want in stockholders' equity, you want to keep things clearly defined between stock and retained earnings. The second is to make sure that your legal capital, legal capital meaning that stock with a particular par value, whether it be common or preferred, clearly separate from additional paid-in capital, where the owners might make or owner might make additional investments in the capital structure of the company. And last but not least, treasury stock is a deduction from stockholders' equity. And treasury stock, we kind of touched upon this in previous chapters. That's where you're buying back stock from the owners of the stock, either on the market, to reduce the number of shares outstanding, so that when calculations like earnings per share are done by potential investors, the earnings per share calculation looks better because you have fewer shares outstanding. Okay, let's move on. Okay, there are a variety of stockholders' equity accounts used. There's about 6 of them, so make sure you get all of these in your notes. First, there is common stock that you need to account for, and you want to make sure that you account for the number of common shares that are issued, and specifically amount representing the legal capital, and this could be defined as a par or stated value if it is applicable. The second is preferred stock, and again, you want to make sure you identify the number of preferred shares issued that represent the amount of legal capital, and here again, this could be par or stated value. Okay, other accounts include treasury stock, which we talked about. And this is treasury stocks primarily represent the number of shares repurchased. And you want to identify the purchase price per share associated with those shares that are repurchased. Other accounts that you would want to make sure you identify and separate are paid-in capital. And then again, this money that is contributed to the company from other sources than a traditional stock issuance. And the other thing that you would, or other equity accounts that you would want to account for, would be paid-in capital from treasury stocks transactions. Okay, so this is primarily paid-in capital that is used to purchase treasury stock, and so you want to make sure that you account for the treasury stock that you buy and the price paid when the treasury stock was repurchased. And of course, you always have retained earnings, and as we've done in our previous chapter, we talked about in our previous chapters, this retained earnings come from past net incomes, of course, minus net losses and minus the past dividends that might have been declared. Okay, there are a couple last things that you need to remember regarding long-term notes payable. And the first is regarding face value. And you want to make sure that you record a note payable at its face value. And the second thing is you want to make sure you report a note payable at its carrying value. And of course, this would be less discounts plus any premiums that might be paid. All right, guys, that concludes chapter 15. Short chapter. Have a great